Let's examine how the CPA's bill payments framework operates, how it uses EDI, how EDI payment items travel, and the rules and standards that govern the process. A payment made via the CPA's bill payments framework is referred to as a bill payment remittance. To create a bill payment remittance, financial institutions need two things. First, they need a remittance. This is the information that tells the customer's financial institution which biller the payment is for and which financial institution is collecting bill payments on behalf of that biller. This remittance can be paper-based or electronic. A paper-based remittance is the bottom detachable portion of an invoice, frequently called a bill stub, that a biller sends to its customers to request a payment. The number 96 is encoded on the remittance to identify the item as a bill payment during automated processing. Other information required to direct the remittance to the billing organization's account at the biller's FI is also encoded on the remittance in special magnetic ink. An electronic remittance is the same data provided by online or telephone banking systems. This electronic data is required by the customer's FI to direct the remittance to the biller's FI. The second thing a financial institution needs to create a bill payment remittance is a remittance amount. This is the payment that the customer provides to their financial institution from their own funds. Payments made at an automated bank machine or in person at a teller may generate paper-based remittance transactions. Payments initiated in an electronic environment, such as telephone and online bill payments, for example, will generate electronic remittance transactions. Once the customer's FI has the remittance and the associated remittance amount, it can initiate a remittance transaction. As soon as the customer's FI initiates the exchange of the paper-based or electronic remittance with the billing organization's FI, that paper or electronic item itself becomes a credit item. A remittance representing the value of the payment that was made to the customer's FI by the customer and must subsequently be applied to the account of the billing organization. Once the billing organization's FI updates the biller's account to reflect receipt of the remittance, the biller will update their own customer account records to reflect the amount of the customer's payment. Of course, if the billing organization receives its payments from its FI in EDI format and has fully integrated its accounting systems, this will be done via straight-through processing, meaning that customer accounts will be updated in a timely manner with no manual intervention. The type of remittance that a biller chooses to accept has implications for the FIs where the customers of the biller pay their bills. If the biller has chosen to accept both paper-based and electronic remittances, for example, the customer's FIs may enter either paper-based or electronic remittances into the clearing and may convert any paper-based remittances to electronic format prior to entering the items. If paper-based remittances are entered into the clearing by their customers' FIs, but the biller has requested that it receive all paid remittances in electronic format, it then becomes the responsibility of the corporate FIs to convert the paper-based remittance to electronic format for delivery to the biller. If a biller has chosen to receive paper remittances only, the paper remittances are not converted to an EDI file and are exchanged and cleared via the same process as checks. Take a look at the checks section in this series to learn more about this process.